Do we have basic connectivity? Like, only 25% of Africans are on the internet. So when you're talking about smartphone-based solutions, it's very difficult to reach outside urban centers in the more mature markets. Very few countries in Africa have payment systems which allow real-time payments and have transaction data which then can be used by fintechs to lend credit and so on and so forth and build profiles of thin-file customers. So there are these structural infrastructure factors, but there's also factors around startup ecosystems in these countries, because you cannot expect a startup to just wake up and make a successful business and then come to an investor like Omidyar Network, which is a Series A investor, all ready to go. So we have to build this from ground up. We need local incubators, local accelerators, seed funders, infrastructure, regulatory support, and so on and so forth to make this happen. Outside credit, credit is one financial service model where the business model is very clear. Outside credit, if you look at payments, if you look at say, for example, pensions, insurance, the business model for low-income consumers is not that clear. And so we think businesses that start by targeting lower and middle-income consumers and then build scale and then use that scale to reduce unit economics to serve lower-income consumers have a better chance of success than businesses who start out by serving the bottom of the pyramid. So that, in our view, is a more sustainable model which eventually reaches the consumers we care about, but in a more self-sustainable way.
Well, the regulator is always in our way. We're trying to innovate. The regulator is throwing up more and more rules. What are you doing with the central bank to create an environment hospitable to innovation?
The regulator does not provide the services. We're talking about financial inclusion. There's business to be made, accounts to be opened, business to expand. But for the regulator, the role he has to play is to define the rules of engagement. So basically for the central bank, to use the central bank as an example, you're concerned about the policy environment in which operators are supposed to, provide their services. Now, when we look at financial inclusion, there are three things that we look at in terms of dimensions to financial inclusion. At the basic level, we are looking at access. And when we are talking about regulatory policies to drive access, you want to think about outreach. Earlier on today, the panel that opened the session, they talked about how do we bring in over 40 million people that are considered outside of the system, okay? And we also heard statistics about the amount of cash that is outside of the formal economy. So for the regulator, you're thinking about access and outreach. How do we bring the people in? So policies that we issue, for instance, need to be fit for mass adoption. Because if the policies can only enable a few people to come in, we have not even started talking about financial inclusion. And there are services we see in the markets today that attract only a certain category of people. While they serve a niche, they will not serve the purpose of financial inclusion, because we are looking at innovation that can bring in people in their thousands and in their millions. So one policy I can talk about, for instance, is the policy on agency banking. Now, this is an area where we feel is critical. And why is this so? As of 2015, the central bank collaborated with a development partner, and we worked on the geospatial mapping of financial access points in the country. We actually geotagged branches, ATMs, agents, and the likes. And what did we find? We found that as of 2015, I'm not talking about 30 or 20 years ago, recent years, right? 30% of local governments in the country did not have a single bank branch. Over 200 points, local government areas. Now, how many branches are we going to deploy to serve thousands and millions of people? That would be very enormous, right? We can't even begin to think of the capital cost. But a policy like mobile agency banking can enhance operators to deploy a fraction of the cost to build a physical branch, to multiply the agents in a local government, for instance. So we are talking about access. So regulators need to continue to think about access. Access drives outreach, because then you can bring in more people. That's one. Now, the second dimension to financial inclusion I'd like us to talk about is usage. It's one thing to bring in the people, and bankers in the room, you know this more than I do. You can bring in somebody today, you do a market storm, 1,000 person comes in, and in a month or two, they're not using the account. We've all had that experience, not so? And I'm sure even some of us in this room have accounts we have not used in a while, for different reasons. So after access, we need to think about usage. And for usage to be sticky, the services we are offering must be relevant. And there was something that excited me at the talk we had before this panel. I think it was when the country director for Visa spoke. He talked about cash. I mean, Nigeria is really, cash-driven and the likes of it. But there was something he said. He said the customer journey. I think we need to do a lot more when we talk about the customer journey. And what essentially is the customer journey? How he interacts with money. We eat, right? We transport, we pay for things. That is essentially the lifestyle we are trying to digitize. So for the policymaker, we want to be sure that the policies in place support usage of the platforms that the operators are putting in place. And the operators need to think about the value they're offering. If the service does not help me to buy food, it does not help me to transport, it does not help me to pay my medical bills, it does not help me to pay my school fees, and whatever other payment needs I have, then it stops being very relevant to my daily need. And if people don't have a business case or a value proposition for financial services, they choose sometimes to self-exclude. Either they don't come into the system at all, or they come and then they become dormant and they don't do much. So the third dimension I'd like to mention is the dimension of quality. Now, as a policymaker, quality is something we're very concerned about. Because at the basic level, when you're talking about financial quality, the quality of financial services, there's a welfare dimension, and I'll explain. Now, I've gone to a rural area. I've spoken to the market woman selling the tomatoes and the pepper, and she has come in, so access has been achieved, right? She's brought in some money. She's done a transaction or another, so she's using. How do I maintain quality? If she goes and she has a bad experience, and that is not addressed, trust becomes shaky. Do we agree? I've personally had different experiences with some financial institutions, and you're like, do I want to continue this? The way I lived my life before, and I transacted with cash, maybe I was better off. So we need to think about those three dimensions when we are talking about policy making. So for the central bank, for instance, we have a framework called consumer protection. And what are we interested in? We're interested in the two sides of the conversation. On one hand, we're looking at those providing the services. Are we providing the services as we have covenanted to provide it? Are we charging as we are supposed to? But on the side of the consumer, we are concerned about their own responsibilities as well. So it's not just the service provider. If as a consumer I've taken a loan and I've agreed to repay, say, monthly, and I don't meet that covenant, my action has implication for the financial institution because they've taken that fund either from a deposit base or they've borrowed externally to fund that credit. Okay? So those three dimensions are the areas I think we need to really focus on when we're talking about enhancing financial inclusion. Access, we drive outreach. Usage needs to drive value. If the services answer a need or they resolve a concern, consumers will be attracted to use, right? And quality, if the way at which the service is being provided meets the responsibility or not of the users, then we can talk about enhancing the expansion.